take a live look at the big board of the New York Stock Exchange. The Dow rose today, building on Monday's news that the U.S. and Iran reached a deal to end this war. Let's bring in Laura Sanicola, the senior writer at Barron's and author of the Barron's Energy Insider newsletter. Laura, great to be with you. The president has said multiple times that oil prices would drastically drop with this agreement with Iran. We have seen some relief, but how long could it take for everyday folks like you and I really feel the difference at the pump? Are there other factors at play when it comes to the price of oil?
Yes, there are. Prices at the pump tend to fall at a slower rate than futures. They rise just as fast as futures and fall slower as retailers work down their inventory. So I would say it should take at least a couple of weeks, 2 to 3 weeks for you to start seeing real meaningful declines at the pump. But given, if this peace deal holds and oil prices, futures prices really do remain lower, I think that those should start to normalize to the levels that you were seeing at the beginning of the year before the crisis started.
Kevin Warsh is overseeing his first meeting as Fed chair. What impact will this agreement between the U.S. and Iran have on interest rates, do you think? I mean, it'll be officially signed on Friday. I'm curious, is that too soon for the Fed to really make a meaningful change based on that?
Well, I think the whole situation is very complicated, right? Because there's going to be a 60-day negotiation period. I think most analysts suggest that neither side really wants to return to a hot war. If they had, perhaps they would have already done that already. But Warsh did come into the job explicitly arguing that interest rates should be lower because his view is that, a stronger productivity in the U.S., a smaller Federal Reserve balance sheet, these are things that should help the economy to grow with lower inflation, and that we should be looking past this. And the war, rather, it did complicate that for him because it was the main driver of inflation over the past few months. But if the oil prices continue to fall in the next few months, I could certainly see a situation in which cuts could happen later in the year. I think most people think that rates will remain stable, and I don't want to argue with the economists because that's their job, but certainly it puts him in a better position, one that he was anticipating before the war broke out.
Yeah, I'm curious, how much is job market uncertainty playing into the Fed's decision, given that the worry for so many people is that AI potentially going to have a huge impact on the unemployment rate? Is that played into this meeting this month?
I definitely think that the Federal Reserve will be analyzing the labor market signals because they have that dual mandate of keeping unemployment low while keeping inflation low as well. And so far, we're not seeing an overheated labor market. And yes, we are seeing news and headlines about how hard the labor market is for recent grads, for example. But, we're still seeing pretty strong labor figures every month. And I think they'll need some more data to really justify any move that's related to a weakening labor market, because right now what we're seeing is it's actually a relatively strong labor market considering all the forces at bay here.
Laura Sanicola, thank you so much.